Welcome back. Markets are holding up in the green, but banks are dragging. Consumption names are weaker. So Britannia, Nestle has gone stock split. So Nestle is down in trade. But in the banking universe, you've got HDFC Bank lower by 0.8% at the day's low. We'll talk more about HDFC Bank, but while the loan growth for the company was nearly 5% on a quarter-on-quarter basis, the deposit growth was just 1.9% on a sequential basis. So is that a factor weighing on HDFC Bank? We'll ask Pranav Gundlapalle, the senior analyst of India Financials at Bernstein, who's with us on the show now. So Pranav, we'll first wanted to get your thoughts in on HDFC Bank's business update, and then we'll talk about the key trends for financials in 2024. So first, how should we read HDFC Bank's numbers and the market verdict?
See, I think it was an average set of numbers. I think the positive front, the loan growth was around 17%, which is not too bad. But the sequential deposit growth was, a lot lower than what the consensus estimates were. But this does point towards a likely margin surprise on the positive side, because with the deposit growth being lower, and especially with the CASA ratio improving, which is a reverse of what you've seen or opposite of the trend you've seen across the board so far, I think the margin should surprise on the upside. So growth is average, but I think the positive surprise could come on the margin front.
So the point about the deposit growth sequentially, missing consensus expectation, deposit growth is 1.9% quarter on quarter. What was the consensus expectation?
See, I think the expectation was that the deposit and loan growth almost move in tandem. So I think that was the expectation. In fact, for the longer term thesis, the requirement rather is that deposit growth outpaces the loan growth, because the bank does have an extremely high LDR ratio at this stage. So, you'd have needed a faster deposit growth. But then you throw in the context of a weak deposit growth across the sector, plus the fact that their CASA ratio has actually gone up, which means the CASA growth is healthy. It's just that they seem to have given up the wholesale deposits. Maybe it's actually helpful on the margin front and something that they can, recover back the next following quarters.
Will this anemic deposit growth, is it a one-off, or do you think it's something that will continue and worry analysts?
Yeah, I think the most important part here is the retail deposits growth, which have remained healthy. I think the other one, you need to remember, there are a lot of other pieces of the puzzle, right? So the bank is trying to, manage its overall liquidity, the liability mix, as well as the margins. So I think you will see a bit of ups and downs on the overall deposit growth. But as long as the retail deposit growth is healthy, I think that's usually a good enough sign.
Okay, got that. That's HDFC Bank. Pranav, hi, and thank you for joining in. I'm looking at your top picks in order of preference. HDFC Bank, there's also Axis, ICICI, SBI, and Kotak. So, practically most of the large names, large players. What, apart from the fact that, there's a tactical play to this, the whole expectation is that we'll start getting a lot of FPI money. So in any case, this money is going to chase these frontline banking stocks. Leaving the tactical argument aside, purely on fundamentals, what could be the biggest triggers that will drive earnings and margins for these frontline banking stocks? If I were to ask you, what's the trend to watch, or what could be the big highlight of 2024, then what would it be?
I think there are 2 or 3 trends here. I think the biggest one would be a return in corporate loan growth. Right? I think return in corporate loan growth is long overdue. And in fact, you've almost had a decade of a banking sector growth being driven almost entirely by the consumer sector. So, and there are enough indicators that point to a likely revival in the corporate credit growth. I think this is going to be the single biggest differentiator amongst banks this year. And the reason is that unlike consumer growth, where most of the banks would actually have a reasonable right to win, corporate credit would be a lot more selective in terms of the banks that can actually capture that growth. And it would be the large 4 or 5 banks that capture a disproportionate share of the corporate credit growth when it comes back. And therefore, that will drive the differentiation, the overall growth between the larger banks versus the smaller, the mid-sized banks. That is number one. Then number 2 is, I think there is a general normalization of the profitability and growth that is set to happen this year. On the growth front, you've already seen signs of that this quarter, that the deposits will become the constraint for growth for banks in general. And as the incremental CASA ratio starts to improve, the larger banks with better deposit franchises will be able to deliver sharper growth, number one. And the second is on the profitability front. I think until the last 12 months, you've had a scenario where the credit costs were a lot lower than the usual. Plus, you had abnormally high NIMs for certain banks. So a lot of that will also start to level off, which means that the bank's ROAs will trend closer towards their sustainable numbers, where again, you will start seeing a differentiation for the large banks versus the smaller and mid-sized banks. So both these factors, the growth from corporate, the deposit divergence, and then the credit cost in general ROA normalization, all of these point towards a better outcome for the larger banks versus the mid-sized or the smaller. So that's really what drives our preference for the large capitals.
Okay, that explains it. Now, let me ask you about beyond the large blue chip banks as well. For instance, I mean, just the other day, look at Bajaj Finance's numbers. Numbers look very, very good, despite all the concern on unsecured, lending and the crackdown and the expected compression in margins, etc. So a word on some of the NBFCs that perhaps we should still watch out for. And, what beyond? For instance, Paytm has had a decent run, a word there. Basically, beyond the large blue chip banks, what are the other major financial names that we should watch out for that could perhaps surprise on the upside in 24?
Right. See, I think on the consumer side, despite all the chatter on asset quality issues in pockets of consumer lending, I think the overall growth will still be healthy, but likely to be slightly lower than what you've had in the past. Now, what that means is franchisees or lenders with a diversified portfolio, like a Bajaj Finance, for instance, would have the luxury of moving from one segment to the other, depending on where the growth is a lot more promising. I think that's where a platform like Bajaj Finance stands to benefit. Whereas for the ones which are focused on a certain segment, and especially on unsecured segments, could see a slowdown in growth. We've already seen Paytm come out and announce that. I think that's already in the price at this stage. But you could see a period where the unsecured segment sees a slightly slower growth, not because of asset quality issues, but because of players choosing to be conservative and taking a wait-and-watch approach, just to make sure that the trouble seen in pockets of the segment don't spill over into the broader segment. We see no indications of that yet, but I'm sure most of the lenders would want to play it safe and wait for a few quarters before accelerating on the unsecured segment. So that is one. The other theme, and the reason why an NBFC like Bajaj Finance and even banks with a heavier share of borrowings would be attractive, is the potential rate cuts that come in the later part of the year. I think with rate cuts likely to come in, the ones with wholesale borrowings, pretty much the entire NBFCs, especially the ones with a fixed rate loan book, will stand to benefit, right? So again, the likes of Bajaj Finance, Chola, a lot of these players would stand to benefit. On the banks front, banks like IndusInd would stand to benefit from a reduction in cost of funds, while their asset side holds up reasonably well despite potential rate cuts.
Okay, all right, Pranav, good chat. Great talking to you. Also had a question on Paytm in specific, because you have a big target on the stock, 900 plus, but we'll have to leave that for another time because we're running out of time on this particular chat. Thank you very much for joining in, and already looking forward to the next one. Well, with that, let's move on now.